The world's largest asset manager, BlackRock, quietly limited withdrawals on a flagship credit fund managing $26 billion in assets. When sophisticated investors are prevented from retrieving their cash, it signals a deeper panic. This freeze is the modern equivalent of a bank run occurring within the highest levels of global finance. This specific fund operates in the world of private credit, a system where non-bank institutions provide loans to businesses through privately negotiated terms instead of public bond sales. To understand the scope of this market, compare it to the primary trigger of the 2008 crisis. The subprime mortgage market was worth roughly $1.3 trillion. Today, the private credit market has grown to an estimated $3 trillion. This localized freeze in a high-end fund is the first visible crack in a shadow banking system that now supports a massive portion of the global economy. This debt market grew to twice the size of the housing bubble in plain sight, largely as a direct result of how we tried to fix the financial system after 2008. After the crash, new regulations forced commercial banks to consolidate and become highly risk-averse. They pivoted away from the complex, bespoke loans that mid-sized businesses rely on to grow. Major banks shifted their focus to standardized products that they could scale with minimal oversight, such as regular mortgages, credit cards, and loans for massive established corporations. This retreat created a massive hole in corporate borrowing. Unregulated private lenders aggressively filled that vacuum, offering the flexibility that traditional banks no longer could. The rules designed to protect the global banking system inadvertently pushed corporate debt into the shadows, empowering a new class of lenders operating outside the view of traditional regulators. This market didn't grow on its own. It was fueled by the rapid expansion of the private equity industry. This ecosystem starts when a private equity fund raises capital from investors. They use that cash as a down payment to borrow even more money to buy a portfolio of private companies. Once acquired, those companies are then loaded with their own separate private credit loans. That borrowed cash is often used to pay back the original fund, recouping the initial investment almost immediately. The private equity fund then takes that extracted cash and uses it as another down payment to buy more companies, which take on more loans to multiply the debt again. While interest rates remained at historic lows, this machine generated paper returns of 20% a year, attracting billions in new capital from investors chasing those high yields. This perpetual motion machine of corporate leverage prioritized financial engineering over the expansion of factories or services. It was a system that could only survive in a zero-interest rate environment. The machine began to stall when the Federal Reserve aggressively raised interest rates to combat inflation. Because most private credit loans have variable rates, the cost of debt for these companies spiked automatically. Loans that were manageable a year ago now carry punishing interest rates of 9% or more. Many mid-sized businesses can no longer afford these sudden, multi-million-dollar jumps in interest payments. Their entire cash flow is now being consumed by the cost of their debt. To stay afloat, these businesses are cutting costs to the bone. This has triggered a wave of layoffs and mass store closures across the country as companies struggle to avoid immediate bankruptcy. These defaults carry significant human stakes. Massive job losses lead to fewer consumers, which deprives businesses of the income they need to pay their lenders, accelerating the cycle of failure. The Federal Reserve's move toward higher rates reversed the flow of capital. The same leverage that accelerated growth on the way up has transformed into a corporate doom loop. This leaves us with one final question. Will the collapse of the shadow market trigger a global financial crash? The contagion is already present. Traditional commercial banks are not isolated. They are currently holding an estimated $300 billion in exposure to these private credit lenders. Unlike in 2008, the U.S. government is facing record debt and persistent inflation, which severely limits its ability to orchestrate a bailout of this scale. Wall Street has built a shadow banking system that is once again too big to fail.